On Wednesday, the Biden administration announced another extension of the interest and pay freeze on federal student loans. So a lot of us were hoping that he would take the initiative and actually cancel federal student loans, or at least a portion of it. Now, that freeze first came during the height of the COVID-19 pandemic and was extended several times, was scheduled to expire on May 1st. However, the Biden administration extended it to August 31st. Now, this comes as inflation, supply chain issues, increased gas prices have all hurt the average American worker. Now, as I mentioned, progressives have been pushing for Biden to cancel student loan debt, all of it. Even as some more moderate Democrats have said, well, we could do 50,000 as Elizabeth Warren had been pushing for, or even 10,000 as some other establishment Democrats have been pushing for. But I'm basically going to tell you why that's not going to happen. While we're not going to very likely not get any student loan debt cancellation. Now, before I get into that, Biden has the authority. It has been shown, there's a memo, the Department of Education, they buried the memo or attempted to. That shows that the president does have the unique power, the unilateral ability to cancel all student loan debt. That is federal, of course. Private student loan debt would not be canceled because that's not under the purview of the federal government, just to be clear. Now, it's been demonstrated that forgiveness would not only be popular among Democratic voters, but it would be a boon for the economy as well, because you have a lot of people that will be free of these debt obligations. That said, there is a group of people that do not want this. And so that group, you're going to be surprised, or not really, Wall Street. Yes, Wall Street apparently is very, very happy with lots and lots of student loan debt. And so now, why is that? I'm going to get into the reasons. So now, something that doesn't get pointed out enough is how student loans, the student loan debt specifically, has been packaged and turned into a security. They are called student loan asset-backed securities, or SLABS for short. So now they are both private and federally insured student loans that are bundled together, rated, and sold in tranches to institutional investors as bonds. And so those institutional investors, of course, can be banks and financial institutions, hedge funds, etc. That debt is turned into investments that are considered to be low risk and high return, or at least decent return. Investors holding SLABs are actually entitled to coupon payments at regular intervals until the security reaches a final maturity. Then they can trade the assets in speculative secondary markets. There is even a forum where SLABs investors are able to anonymously discuss assets and transactions free from unwanted public scrutiny. So here we go. We have another short situation. Because SLABs are considered to be a sure bet for the banks, hedge funds, and big players, they will use that packaged debt to then ask for more money, more loans, or use it to make riskier bets. Have we seen this before? Oh, yes. Given that many student loans are guaranteed by the government and that student loan debt obligations are difficult, if not impossible, for many to escape, again, you have to go and show the court very, very specific circumstances of where you're not able to pay your loans. Now, I have talked about one of the recent cases where you had somebody that became permanently disabled, finally actually able to get away from their student loans because there was no way they'd be able to pay them back. Even then, the Biden administration had fought on the case, on the side, of the student loan companies in order to collect those student loans. Until, of course, there was enough pressure to get him to back off. And so, again, I'm not surprised at all, and you shouldn't be surprised that Biden is a main architect of this and why he would be against this. Remember, he made it so that borrowers could not declare bankruptcy from student loans. There's a reason he is called Credit Card Joe. So now, the next issue here related to SLABS is, how dangerous are they? How many of these student loan asset-backed securities are out there? It turns out a lot. In total, approximately $600 billion worth of SLABS, it's over $500 billion, have been issued since their creation in 1992. And possibly more. And again, it's not just the SLABS themselves, but also bets related to them, references to them that could be tied in trillions of dollars of other investments. These SLABS have been issued to investors at rates that outpace other asset-backed securities and include new private loans made by Sallie Mae and newcomers like Sophie and Navient, who was a Sallie Mae spinoff. And because it's so big of a market, if SLABS failed, if the investments, say you had a even more default, a mass defaults, what do you think that's going to do to them? That has the potential to impact the entire U.S. economy. But hey, it's a good thing they're rated safe, right? Well, not so much. You see, SLABS are rated from AAA to B. Now, B is a junk, right? So that's a junk bond. But all the SLABS are marketed as safe because of that marketing, of course, you have demand that is greater than supply. So you have all these investors that are looking at SLABS because they're marketed as being super safe and very lucrative, and that number continues to grow because tuitions get higher, people take out more loans, and the government isn't picky about who they loan out to. And so you have that situation, and you also, and by the way, this is Wall Street 101, the more toxic and risky that debt is, the more they can make off of it. That's even worse. So that incentivizes terrible investments. Now, these loans, as I mentioned, they're not safe. Just like during the subprime mortgage crisis, the more toxic kind of loan, the more risk, the more reward. An example is SLM Private Education Student Loan 2009 CT Trust. So that is a SLABS product created from loans issued by Sallie Mae. And it consists of more than 40,000 loans made to students that were attending unaccredited trade schools, such as truck driving. Okay, that's fine. Cosmetology school. Okay, sure. And even a dog walking school. Dog walking? Dog walking. And again, these are all unaccredited colleges. For all we know, there could have been Trump University in there. Now, that debt doesn't go away either. So if you took out money, and this was federally backed, and not even federally backed, the private loans are also securitized in this as well. And so if you take out a private loan for this, for their dog walking school, and don't land a job dog walking that it earns you $60,000 a year, well, I mean, again, you're screwed. But because of federal rules, you're still, it's still very difficult to discharge even a private student loan. So now that said, you would think that that would look very risky. All these unaccredited schools, this high amount of debt, and the high amount of defaults. However, when the SLM Private Education Student Loans 2009 CT Trust was issued back in 2009, one of the raters, Moody's, gave the SLABS a rating of AAA. The highest rating they could give. The highest. This seems to be a pretty, I don't know, toxic security. And yet, highest rating ever. Highest ever. Why? Well, it turns out that Moody's is incentivized to give out AAA ratings to basically everyone involved. Now, there are 3 rating companies, all of them private: Moody's, Standard & Poor's, and Fitch Ratings. These companies are paid to rate the slabs and are also tasked for government oversight as nationally recognized statistical ratings organizations. The credit rating agencies not only rate the slabs, but are paid to rate them by the loan issuers like Navient and Nelnet. So wait a minute, you are paid by the very companies that you are tasked with rating their securities products. Is that not a conflict of interest? It is. It sure seems like it. Now, it gets worse because these loans are dependent on people getting themselves into massive amounts of debt. So now, the thing about these loans, right? The thing about these securities is that the longer life you have on the loan, the better off they are. So if you're in an IBR, for example, an income-based repayment plan, that's good for them because they can continue to sell and repackage that debt over and over and over again after the maturity dates and make a return on investment. That incentivizes, once again, for tuitions to go up, for loan amounts to increase, making it so, people have a very, very difficult time paying off those loans, so they have to take longer and longer periods in order to pay them off. Combine that with the fact that you cannot discharge them through bankruptcy. Well, this is very, very lucrative for them. Now, the problem, of course, comes when we start talking about student loan debt cancellation. If you end that, you end those loans, and there goes their profit. There goes those investments. And so, now, that said, the more toxic the loan, the more it's worth. But because it's toxic, if you default, it's also bad for them. So if you don't pay that, unless they bet against it, I should say, this whole situation, though, really looks like it's akin to the subprime mortgage crisis. But it's even worse than that, because during the subprime mortgage crisis, well, mortgage-backed securities were, there was at least some collateral, right? That was collateralized debt. This is not collateralized. What are they going to do? Take your degree? No. There's no collateral that they can take to at least recoup some of their losses. And so they're completely out of all of it. Gone. That means trouble if you have all of these securities that you have leveraged in other, not only getting loans for your company, but also investing in other things with that money with expected returns. If that dries up, that's gone, then you're at risk of default. You're at risk as a investor of losing everything you have that is based on these securities. So that's why this is a gigantic bubble. And this bubble, like many, many bubbles, is going to burst unless something is done about this. And by the way, getting back to these rating agencies, right? Now, the rating agencies, they realize that if they do not rate even the most toxic securities as AAA, then they're not going to get sold. That you're going to have people that are holding these loans, holding these securities without any collateral, and are going to eat that entire loss. So what are they forced to do? AAA, 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 rubber stamp. And that's it. And so that also creates huge problems with that entire market. That's going to make financial institutions fail. And if those institutions fail, other institutions that rely on money from those will fail. Lending will dry up for student loans. And so the whole house of cards is going to fall all in on itself. In fact, Samantha Bailey and Chris Ryan did a report called The Next Big Short: COVID-19 Student Loan Discharge in Bankruptcy and the SLABS Market. And it gives more detail and a warning. Here's what they wrote. It is likely a question of when, not if, the SLABS market will collapse. And when it does, private student lending will be crippled, carrying serious negative effects for student borrowers, as well as the colleges that they attend that rely on that funding. If the 2008 recession was any indication, these developments could happen very quickly and ripple into the rest of the United States economy due to the sheer size and scope of student loan debt in relation to overall consumer debt. Student loans are $1.9 trillion. And so what's going to happen if you have that bubble that bursts? Recession, bailout, depression? I don't know. This is all coming back to why Biden's not going to do a damn thing about it. Biden's going to sit there and hope that this bubble does not burst while he's in office. Because either, in order to solve this problem, he would have to go in and regulate SLABS, which of course would make these investors lose a lot of their value. And since banks and credit card companies and debt collection companies and student loan companies are all whispering into the president's ear, control many members of Congress as well, he's not going to intervene because he listens to those corporations. And it's not just Joe Biden, but I think any president is not going to risk blowing up the entire economy by trying to, and by the way, it's inevitably going to blow up anyway. And so this is a loser situation. This is the next bubble, and it is going to burst. Whether or not somebody does something about them or not. And yes, as some of you point out, what's going to happen when that happens, when that blows up, is there will be massive bailouts on these financial vehicles. Bailouts for the banks, but not for us. And so that's, I think, the main reason why we are never going to see, not with Joe Biden and not with any establishment Democrat, student loan debt cancellation. Maybe on a very, very small scale, $10,000 is still on the table. As long as it keeps that money going, as long as it keeps these markets continuing and these banks able to make money off, betting on these security or securitizing your student loan debt, as long as that debt exists, they're going to make money off of it, and they're incentivized to keep it going.